Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brett Friedman, OptionMetrics contributor and managing partner of Winhall Risk Analytics, to discuss the impact of the Ukraine war on commodities. It is great to have you with us, Brett. Welcome to Trade Talks.
Thank you for having me.
You got it. The beginning of the war was a shock to commodity markets. Why do you think the markets were caught off guard?
Mostly because the markets didn't appreciate the potential scope of the conflict. Ukraine had been in the news roughly since the invasion of Crimea in 2014, but they didn't really appreciate the extent of the West's response or the extent of the conflict itself. Also, the shock was exacerbated by the fact that the markets were actually moving up for about 3 months before the war started. If the markets had been moving down, then the shock would have been even greater. So the markets were totally taken off guard by it. Mostly, as in all shocks, at the root of it, a failure of imagination to understand what could possibly take place.
Were you surprised by the ability of the markets to adapt to a new situation?
Not really, but no one's really surprised in retrospect, quite honestly. In this case, the shock mostly affected energy and agricultures. That being the case, there would be severe ramifications due to high energy costs and high food prices at the same time. Politicians generally tend to react when their population is cold and hungry and can't drive around. So in Europe, this was a particularly large issue. So they adapted their facilities to get new energy supplies. Agriculture was, due to the port situation, was affected for a little while, but then sort of adapted as well. The biggest adaptation, obviously, was in natural gas with the LNG situation.
What are the long-term effects of the war, if any? Walk us through a couple charts here so we can take a look at some of the price action.
Sure. Let's start with natural gas, if we can. The biggest surprise in all of these charts is that what no one would have predicted when the war began last February was that prices and volatilities, implied volatilities, are actually a lot lower than when the war started. So the initial shock, natural gas was sort of an outlier because of their slow speed it was affected by the European energy situation, that they had sort of a slow speed energy crisis. But as you can see here, I mean, not only the underlying is considerably lower than last March. Interestingly, with natural gas, however, which sort of portends as to what could happen, implied volatility, the uncertainty gauge, is hanging up. It's come off considerably from the highs, but it still hasn't come off as much as prices would seem to indicate. So natural gas is a pretty good example of a market that adapted. Europeans started importing LNG from the United States, and the situation was alleviated. You see that in the other charts as well, is that prices and volatilities are considerably lower. And this is, no one, I think, last March when the war broke out would have predicted that. I think it's a real testament to the resiliency of the markets, especially the energy markets, to adapt. These are worldwide markets. Supplies can come from many different places. So,
yeah, well, I mean, the war is no longer supplying the physical and psychological shocks necessary to sustain the prices, as we saw in the nat gas chart. So, what's keeping risk managers up at night?
What always keeps risk managers up at night? It's the unpredicted events, the things that come completely out of left field. Last week we had a really good example with SVB. That came out of nowhere, and it was a gigantic shock to the system. But look what happened. Now we're on day 2, and or day 3, however you want to look at it. Things are starting to calm down. But it's these shocks to the system that are continuously fueled by new events that are the scary ones. Currently, what you would see is things that people aren't really talking about, like, right now, it is assumed that the Ukraine war is going back and forth, no big deal, and there isn't a clear winner or loser. Well, what happens if a ceasefire is suddenly, secretly, arranged by somebody? That would be a gigantic shock to the market. to come up to the commodity markets, the equity markets, and the interest rate markets, is no one's really talking about that at all. Similarly, for a little while, Taiwan was in the news, a possible, hostilities in Taiwan. You don't see much press about that anymore. Other things have taken center stage. So it's these things that just sort of come out of nowhere that really shock you. As a risk manager, I can tell you the other thing that keeps me up at night are things that happen in commodities or asset classes that are not in my book, but have a giant effect on my book. So something happens in interest rates that completely screws over my commodity book. It's like I had nothing to do with that. So that's what keeps me up at night.
Yeah,
So
and it could also be to the short or long side as well. If you're not pricing in a ceasefire and you're thinking this could go on another 2-3 years, and let's say you don't have either long positions in it or you're overly hedged, or you're not expecting these positions to move higher because there is a ceasefire that's announced, it works for both sides as well. It really does depend on your time frame and just how you are positioned. Of
course, and the knee-jerk reaction to any big external unpolitical event is usually to buy. We're gonna take this stuff. But in the case of a ceasefire, I imagine, it's an incredible, to me, it would be a very bearish event for commodities, a very bullish event for the equity markets, bullish event for the economy. So it might be bearish for commodities immediately, but then they would realize the economy's, this is a great economic event. We're going to start, production's going to start going up. We're going to start buying commodities. But the initial shock, it's always like, oh, whoa, what should we do? Right. And now, interestingly enough, 2 years ago, you had negative crude oil prices. That was a great shock. No one knew that could happen, possibly exacerbated by the fact that nobody was in trading rooms and no one knew exactly what to do. But that was a great example. Crude oil currently is kind of, traders would disagree with me, but it's in sort of a quiet phase. It's not much. You're not seeing giant effects from like Ukraine or anything like this. So, yeah. All right. Well, interesting. You always have to think another step ahead, because especially with everything so digitized, like we saw with SVB, how fast that the news filters, it's a little bit different to your point. Let's say, it was a decade or two ago where you could sit on a desk and you kind of, map these things out with your fellow traders, but things just happen so fast because they're digitized. Not only can you process it faster, you can move your positions faster. So it does make your job as a risk manager just another element even tougher. Yeah. And it used to be, one of the effects of that, like during the first Gulf War, when I was trading crude oil and energy, it was a professional market. We didn't get commentary from retail traders or anyone who wasn't in the business affecting markets. Now you get that. Everyone has an opinion, but not all opinions are created equal. So, but people listen to them, and it moves the markets around. So the volatility of volatility, if you look at the stuff that OptionMetrics produces, the volatility of volatility is going up. And I think that social media is one of the reasons that's occurring, is that the news is disseminated faster and digested faster, and not necessarily better. Right. Well, now we can start layering ChatGPT and all the other properties that Web3 and AI allow us to do. Brett, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Thank you.